Hey everyone, welcome to today's Explainer. Now, if you've been staring at your portfolio lately, kind of wondering what the next big evolution in investing looks like, well, you are in exactly the right place. Today, we are unpacking a financial product that is literally shaking up the market landscape in 2026. We're talking about specialized investment funds, or SIFs. This is the product that everyone is whispering about right now, and by the end of this analysis, you're going to understand exactly why. We're going to use the absolute latest data, fresh from the market, to break down the winners, the strategies, and yes, the risks.
Okay, let's dive into this. Here's our roadmap for today. First, we'll officially meet the SIF. Second, we'll look at the April 2026 scorecard. Third, we'll decode Quant's winning strategy. Fourth, we'll help you find your perfect match. And finally, we'll read the fine print.
All right, Section 1, Lead the SIF, the new middle ground. To really appreciate what these funds are, you have to understand the gap that SEBI identified back in 2025, where everyday investors were essentially trapped between two extremes. On one side, you had your standard mutual funds, and on the other, super expensive portfolio management services. SEBI basically created SIFs to sit right in the middle. And right off the bat, the most fascinating thing here is the sheer accessibility. We are talking about a minimum investment of just 1 lakh rupees. Think about that for a second. Previously, if you wanted access to advanced alternative investment fund strategies, you needed massive capital. We're talking millions of rupees just to get your foot in the door. SIFs completely flip that script. They bring these sophisticated high net worth trading strategies right to the retail investor, without the massive overhead or those staggering entry fees. It's honestly a total democratization of advanced investing. So, what exactly are you buying into? Well, a specialized investment fund is fundamentally an advanced investment vehicle. Unlike a traditional fund that basically just buys a bunch of stocks and sits on them, SIFs are authorized to use incredibly complex, dynamic strategies. We're talking long-short derivatives, really intricate arbitrage setups, and blending different asset classes on the fly. They're built to hunt for extra returns and exploit market inefficiencies in ways that standard funds just literally aren't legally allowed to do. The crucial difference here is simple, but it's incredibly powerful. You see, a traditional mutual fund is typically a long-only vehicle. That means they buy a stock and just hope the market goes up. If the market crashes, well, their portfolio generally goes right down with it. They rely entirely on market growth. But SIFs, they have the unique flexibility to use long and short derivatives. This means they can take a long position to profit when things go up and a short position to actually make money when a stock or even the broader market is falling. They can literally profit in both directions. Because they have that kind of flexibility, the SIF landscape has completely exploded. Between October 2025 and March 2026, we saw a massive flurry of launches, and today there are about 16 to 19 active funds out there. They generally fall into 4 main buckets. First, the hybrid long-short, which is the most popular right now, blending equity, debt, arbitrage, and derivatives. Then, pure equity long-short. Next, you have the highly aggressive equity X top 100 long-short, which totally ignores the biggest companies to focus purely on mid and small caps. And finally, the multi-asset allocators. Moving right along to Section 2, the April 2026 scorecard. Now, it's one thing to have a great theory on paper, but how are these funds actually performing in the real world? Let's look at the numbers. April was a really fascinating month, marked by strong market recovery, and it acted as the ultimate stress test for these new funds. It's really all about finding your personal Goldilocks zone. On the super conservative end, you have Edelweiss Altiva. They use a hybrid long-short strategy, keeping 20 to 40% in arbitrage and covered calls. It's very low risk and has delivered a really steady plus 5.35% since inception. For a more medium risk, stable ride, you've got funds from SBI and Tata. But then there's Quant's X Top 100 fund. This is an extremely high-risk equity long-short strategy, and it was the undisputed absolute top performer of the month. Which brings us to Section 3, Decoding Quant's Strategy. When a single fund dominates a brand new category like that, we really need to pop the hood and look at the engine. Because Quant didn't just beat the April benchmark, they absolutely shattered it. Okay, just let this number sink in for a second. Plus 15.38%. Actually, let me clarify. That is not an annual return. That is a 1-month return, generated in April 2026 by the Quant X Top 100 Long Short Fund. How on earth does a fund achieve that massive of a return in just 30 days? Well, you definitely don't get those kinds of numbers by just picking a few good stocks and crossing your fingers. You get them through a highly aggressive, deeply systematic, and ruthlessly efficient mathematical approach. At the very core of that performance is their proprietary winning formula.
They call it the VLRT framework. This is essentially how they systemize the madness. Step 1 is value, finding the true intrinsic worth of an asset. Step 2 is liquidity, making sure they can get in and out of the asset instantly. Step 3 is risk, calculating the exact downside potential. And step 4, which is probably the most critical for them, is timing. They systematically run through these 4 steps before a single rupee ever hits the market.
And they power that whole VLRT framework with a serious technological edge known as the Marco model. That stands for Multi-Asset Risk and Correlation Optimization. Look, this isn't some guy sitting at a desk reading the morning news. This is a complex model that rapidly analyzes massive data sets to catch momentum and mean reversion signals. During market volatility, Marco shifts gears instantly. It takes short positions when the market starts falling and pivots right back to long positions the second a recovery begins. And because they focus heavily on mid and small caps, where the market is a bit less efficient, this lightning-fast quantitative approach exploits those gaps perfectly.
All right, section 4, finding your perfect match. Because let's be real, a 15% monthly return is incredibly exciting, but those high returns absolutely do not matter if the fund doesn't match your personal risk appetite. These are highly specialized tools. It's like using a sledgehammer to hang a picture frame. You're just going to destroy the wall. The exact same logic applies to your portfolio. So you have to ask yourself, who are you as an investor? If you're highly conservative and you're just looking for FD-like safety, you probably belong with Edelweiss or Bandhan. If you want medium risk with steady growth, SBI or Tata is going to be your home. But if you have a massive risk appetite and you're ready to stomach level 5 volatility for a chance at those huge returns, then Quant is definitely your match. And you know, if you just sleep better at night knowing a massive legacy institution is holding your money, ICICI Pru is the way to go. But regardless of your profile, how much of your actual money should go into a SIF? Well, the overwhelming expert consensus right now is a 10 to 20% allocation, really hitting a sweet spot right around 15%. Your core 85% should definitely remain in stable, traditional assets. And remember, because of the complex nature of these strategies, you really need to lock this money in with a 2 to 3 year investment horizon. This is absolutely not the place for next month's rent money. Finally, section 5, the fine print. Pros, cons, and taxes. Because every single financial product out there has hidden caveats you need to understand before you click invest. SIFs are amazing, but they aren't magic. Let's pull back the curtain. To be completely impartial here, the advantages are incredible. You get daily NAV pricing and daily liquidity, which is super rare for strategies this advanced. You get the flexibility to profit in both rising and falling markets, and you get all of that starting at just one lock. But the trade-offs are very real. The risk level is exceptionally high, especially with funds like Quant operating at a level 5 risk. And crucially, because this is a brand new category launched by CB, you're largely investing in mathematical models, not a decades-long track record of proven performance. And yeah, we have to talk about taxes, because it's never about what you make, it's about what you keep, right? If you hold your SIF investment for more than 12 months, your profits will be subject to a 12.5% long-term capital gains tax. But if you panic and sell before that 12-month mark, your short-term capital gains will be taxed right according to your standard income tax slab rate. Please keep this etched in your memory when you're planning out that 2 to 3 year horizon. Ultimately, SIFs are incredibly powerful tools. They are literally bringing hedge fund level strategies right to the everyday investor's fingertips. But as we've seen today, past performance is never a guarantee of future results, and massive returns always walk hand in hand with massive risk. Always consult your financial advisor and read those scheme documents carefully. So, I'll leave you with this final thought. Are you ready to trade the comfort of traditional investing for the thrill of a long-short strategy? Let us know where your portfolio stands. Until next time, keep questioning the consensus.